Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows and webinars, is for informational purposes only concerning Market Chameleon's tools and products. With that, one last look at the disclaimer. And let's welcome Dimitri Pargamonic to the stage. How you doing, D?
Good morning, Will. How are you?
Morning. Everything's good.
Let me share my screen here. And what we'll do today, let me start actually from the main page. We'll go over another option strategy benchmark. It's a double bull spread. And it's just going to continue on the conversations we've had tracking option strategies. And let's go to SPY for our example. I'm going to type in SPY up top in a search box. We get to SPY's main page, and on the left-hand side, there's a menu. Click on options, and then go to strategy benchmarks. I'm going to close this menu to expand our screen. And up top, we have these different tabs.
Hey, everyone. It looks like we lost D. If you give me a second, I am going to give him a shout and see what's up. Hold on. Hey, everyone. We're back. Take a look at the disclaimer again, and let's get D back in. Hey, D, sorry about that.
Hey, no
Some
problem.
sort of connection issue on your end. No problem.
Okay.
Welcome back. You want to look at your screen again?
Yep. All right. So I don't know where I dropped off.
I think you froze when you went from the main page to SPYs when you froze.
Okay. So once you get into
you froze on the benchmark page, basically.
Okay. All right. So let's stop here we'll start from here, the double bull spread. Okay. We got to this strategy benchmarks. On the left hand side, you have the main menu for SPY. Click on strategy benchmarks. I'm going to close that menu now. And we selected the double bull spread. And this strategy, it's a bullish outlook, and it involves 4 legs, 4 different options. And so you could think of it as the first part of it is you're getting buying or getting long and out of the money call spread. So that's a bullish outlook. You're paying a debit for that. And selling an out of the money put spread, also bullish outlook, and you're getting a credit for that. So it will depend on the cost of each spread. You could end up with a net debit or net credit, right? So if you're paying more for the call spread than you're receiving for the put spread, you're going to end up with a debit. If you're paying one price for the call spread, but you receive more for selling the put spread, then you'll end up with a net credit. Okay, so that will depend on how the options and prices line up. Just to get an idea what this spread looks, the payout looks like at expiration, we have this drawn here. It's a payout diagram. It's a sample, and you could see that we're buying a call, strike C. So if the stock is right here, current price, strike C is an out of the money call, right, above the current stock price. And then you're selling strike D, call spread, which is a higher strike than C. So that's a call spread. And then you're selling an out of the money put. So you can see here strike B, and buying another out of the money put on a lower strike, strike A. Now, if the stock goes up, you can see above strike C, this will go profitable at expiration. If it goes down, well, you're short the put spread. So down here, that's your risk. And the middle part, that will depend, it's gray because that will depend on the cost of this strategy. So if you're paying a net debit, then you're risking losing that amount if the stock closes in between the strike B and C, because all those options become worthless, right? Your out of the money call spread's worthless, out of the money put spread's worthless. But if you paid some debit, that goes away. If you receive a credit, well, all of them are worthless and you keep that credit. So this gray area could be green or red depending on, the price you establish that initial position. So now that we see the spread and the strategy, how do we track it? Is it currently, how much does it cost currently? And how does that compare to its history? So we need some kind of a benchmark, because just observing options themselves, we can't look at we can't really look at that history because things are moving around. But we want to know just the cost of establishing a certain strategy. So what we do is create this benchmark. And one is we need a constant maturity. So here, this one is looking at a 30-day constant maturity, because we're trying to compare, the cost of this strategy today versus this cost of a similar strategy yesterday versus cost of a similar strategy the day before. So we need a constant maturity. So this benchmark has a 30-day constant maturity. We have a 60-day, 90-day, 120. Let's stay with the 30-day constant maturity. And to get that, we use a weighted average formula or methodology similar to the VIX. Once we have the 30-day maturity, then we need to establish, well, which strikes are we looking at? Because you could have a call spread that's way out of the money. You could have it, a little bit out of the money. So how do we, standardize that part? And you could see here that we establish a call spread that is buying a call that's 2% out of the money, then selling another call 5% out of the money. Okay, so that's how we define that call spread. What about the put spread, where we're looking at a 2% out of the money put, selling that, buying a 5% out of the money put. Okay, so we do it by percentages because this way we create that synthetic option, and then we're comparing, apples to apples as we go. So what's the cost of that strategy currently? That equates to 0.3% of the spot price. And we're using percentages so we could compare it to history, right? Because the stock is moving around, right? So what is it relative to the spot price? And here it's 0.3% of whatever the spot price was. Did that go up or down on the day? That was up 0.1%. And how does that compare to its history? Well, if we just took the average daily cost over the last 52 weeks, it was 0.2%. So you could see that it cost a little bit more to put this side of the strategy on a long bullish spread than history. And if we wanted to just see it on a graph, this is what it looked like on a graph. And so what does that mean? Well, as the cost increases of this spread, right? Because this spread, think of it this way, it involves lots of a bullish double spread really looks at the skew along the downside and upside, right? So what we're tracking is kind of like, the skew. And as the cost goes up, right? If the cost is going up on the bullish, means that the markets are now lining up the skew, lining up the options for a more bullish or upside outlook on in this. So as this is going up, right, the skew is implying a more bullish outlook. As this is going down, it's implying a more bearish outlook. So that's kind of like the insight that we could get from looking at and tracking this spread, right? That's because buying out of the monies, we're selling that out of the monies outlook. And also, it could just be a place where you look for potential opportunities if you have a certain outlook. You may be disagreeing with the markets. They could be bullish, you could be bearish, but now you have a sense of where the markets are lining things up relative to history. And you can see here that if we just looking at this graph, that right now we're above, at least where we last closed, right? Where markets closed right now, it's pre-market, but this is looking at yesterday's over here, and you can see from history. So right now it's on the higher end of the historical range. Right, here's this dotted line represents the average of all the observations, and this is how much it moves around the average. So the line lets us see, how much volatility or how much dispersion or variance there is around that average. Okay, so you could see how it fluctuates and moves around there. And right now we're on the higher end of that historical range. If we wanted to go out further, let's say we have we don't have a 30-day outlook, maybe a more bullish outlook going out 60 days or 90 days, then we could look and see, well, how much would that cost? What is the cost of that strategy? So you can see here that is 0.5% versus 0.4 historically. If we go out 90 days, 0.5%, and if we go out 120 days, 0.6%. Okay, so this allows you to look at that strategy and not only compare within one maturity, but now you're looking at it and able to compare it along the term structure as you go out further, right? The relative cost of this strategy going out, further than 30 days. Okay. Another thing that it allows, besides getting insights and looking for opportunities, you could also compare cross asset. For example, if we think that the market will go up and everything turns to one beta, and all stocks have this, or similar assets have the same likelihood of going up. Here we need like a 5% move, right? To get this D here represents a 5% move. Well, let's compare what it would be in QQQ. Is it less expensive or more expensive to put on this similar strategy in QQQ? So we could go to QQQ, type it up here, click enter, and now we see QQQ on a relative basis, it's the same, 0.3%. So it wouldn't, cost-wise, when we convert it to percentages, it would be similar, QQQ and SPY. It would be 0.3% of spot price. So Will, I think I covered this strategy fully at this point, so I'm going to stop right there.
That was a great job, D. Thank you so much. These benchmarks are certainly helpful. Everyone, thank you for joining. Remember to like, follow, thumbs up on YouTube or any other social platform you see us on. Great job as always, D. Everyone have a great day and stay safe out there. Thanks, D.
Thanks, everyone. Stay safe out there and hope to see you guys tomorrow.
Trade in peace, chameleons. Everyone have a great day. Bye-bye.
Bye.